Are UK crypto exchanges walking a tightrope over a sea of tax evasion risks? With new laws coming into force, the government isn't just tightening the screws, they are setting the stage for corporate criminal prosecution. Stay tuned as we dive into how HMRC is turning up the heat on crypto platforms and what this means for investors like you. Welcome back everybody to Enter Crypto with me, Chris Kenyon. Now in today's video, we're going to be tackling a massive development in the UK crypto space that could change the game for exchanges and investors alike. Tax evasion in crypto has been a grey area for years, but with upcoming legislation, that grey area is about to disappear. In this video, we're going to explore why the UK is ramping up its focus on crypto tax compliance, how new reporting rules will affect exchanges and investors, and also the looming threat of corporate criminal liability for platforms. So grab your favourite drink, settle in, and let's unravel what's really happening behind the scenes. So it's no secret that the UK government has had its eyes on crypto for years, but things are escalating fast. Back in March 2021, HMRC released a crypto assets manual outlining how traditional tax rules apply to digital assets, and many investors didn't and don't realise that capital gains tax isn't just about converting crypto to cash. It can actually apply when you trade one token for another or even give tokens away. And it's not just about capital gains, because if you're mining, staking or receiving airdrops, you could owe income tax, especially if these activities are part of a trade. Now, the nuances are confusing, and that's exactly why HMRC is so concerned about non-compliance. And HMRC are not just sat back, watching silently. They have sent thousands of nudge letters to investors, urging them to come clean about underreported crypto earnings. In November 2023, HMRC even launched a voluntary disclosure facility specifically for crypto. And to make things even more transparent, the self-assessment tax return now even includes a section just for reporting crypto assets. But here's the twist. Transactions in crypto are not easily traceable using traditional methods. And HMRC has been relying on data from crypto exchanges since 2019. And they have the power to basically compel exchanges to share user information. But the question is, how far can they go, especially when dealing with overseas exchanges? Now, HMRC do have a secret weapon up their sleeves, and it's coming in the form of what is called the Organisation for Economic Cooperation and Development Crypto Asset Reporting Framework, or CARF. And this framework is a game changer for compliance, because starting from January the 1st, 2026, roughly 1 year from now, UK-based crypto exchanges will need to collect and verify user details. They're going to have to track transactions, and then they're going to have to report everything back to HMRC. And by May 2027, this data will cover both UK and non-UK residents, creating an unprecedented level of transparency. And the penalties for non-compliance are severe. There's going to be daily fines and per incident penalties that will, if they're not complying, will stack up really, really quickly. And for crypto platforms, these stakes just couldn't be higher. And here's where it gets even more intense, because HMRC are not just targeting individual investors. I know it feels like that a lot of the time, but here they're actually gearing up to go after exchanges themselves. And under the Criminal Finances Act of 2017, platforms can now be held liable if an associated person, be it an employee, agent or third party, facilitates tax evasion. And this applies to exchanges outside the UK as well. And the only defence will be having robust prevention procedures in place. And unfortunately, many businesses are just woefully unprepared. A marketed off-the-shelf compliance kit just isn't going to cut it in crypto after next year. Now let's talk about the bigger picture and Labour's compliance culture. With a Labour government, HMRC is expected to double down on tax compliance because their strategy will be to focus resources where they're going to get the most bang for their buck. And crypto exchanges are prime targets because prosecuting a platform can address hundreds or even thousands of cases of non-compliance all at once. And with the FCA's crypto roadmap emphasising regulation, exchanges should already be adapting to this compliance culture. And because a failure to prepare could result in the UK's first corporate conviction for tax evasion under these new rules. And let's not forget that the additional fraud prevention laws that are coming into play in September 2025. So what does this mean for investors like you and me? And even accredited investors, but also, what does it mean for exchanges? Well, for exchanges, it is a big wake-up call. Robust compliance systems are not optional. The government's telling them that they are going to be essential for survival in this new era of regulation. And for investors, ignorance isn't bliss. Staying informed and being proactive about your tax obligations is going to be more important than ever. The crypto space has always been about innovation and evolution, but as this story unfolds, one thing is clear, and that is that the message from the government is that the age of unregulated crypto is definitely ending and the era of accountability is actually here. Thank you for watching, everybody. Thank you for listening. If you found this video valuable, hit that like button and subscribe for more insights into the evolving world of crypto. If you've got any questions or thoughts about these upcoming regulations, then drop a question or a comment below. I would love to hear your perspective. Until next time, stay informed, stay prepared, and as always, keep exploring the future of finance. I'll see you in the next one.